Welcome back to the Daily Crypto Deep Dive. Today we are looking at something that, at first glance, looks slightly unusual in global markets. Over the last several days, stock markets around the world have been under pressure as investors react to rising geopolitical tensions and uncertainty surrounding the Middle East. Energy markets have moved sharply, volatility expectations have risen, and macro investors have started reassessing risk across their portfolios. Historically, moments like this have triggered broad selling across risk assets, especially assets perceived to be speculative or volatile. But what we are seeing right now in the crypto market looks slightly different, and that difference is exactly what makes today's discussion worth unpacking. Before we go any further, though, we need to acknowledge something up front, because regular listeners of this show will know that we have discussed the digital gold narrative many times before. The theory that Bitcoin could eventually evolve into something resembling a geopolitical hedge is one of the longest-running debates in the entire crypto industry. Usually when we talk about that idea, it is largely theoretical, because analysts are debating correlations, studying charts, and arguing about how Bitcoin might behave during future crises. Investors compare Bitcoin to gold, or sometimes to technology stocks, depending on which data set they prefer. Those conversations are interesting, but they are still speculative because they rely on models rather than real events. Every so often, though, markets present us with something much more useful than a theory, which is a genuine real-world stress test. That is exactly what this moment may represent. Global equity markets have been reacting to geopolitical uncertainty, and energy prices have been rising as investors consider potential supply disruptions. Oil markets matter enormously for the global economy because higher energy prices ripple through everything from shipping to manufacturing to inflation expectations. When energy costs rise quickly, equity markets tend to react negatively because companies face higher operating expenses and weaker profit margins. That dynamic has played out repeatedly throughout modern financial history whenever geopolitical tensions threaten oil supply. But during this particular episode of uncertainty, Bitcoin has not collapsed in the way many critics might have expected. Instead, the asset has held within its trading range far more effectively than traditional equities. Prices have moved, of course, because Bitcoin is still a volatile asset, but the overall structure of the market has remained surprisingly stable. Analysts have been quick to point out that this resilience may reflect deeper structural changes within the crypto ecosystem. Over the last several years, Bitcoin has transformed from a niche digital asset into something far more integrated with global capital markets. The launch of spot Bitcoin ETFs, the growth of institutional custody solutions, and the maturation of derivatives markets have all contributed to that transformation. These developments mean that the forces driving Bitcoin's price today are not the same forces that dominated the market 5 or 10 years ago. One of the most important shifts has been the arrival of institutional capital through the ETF market. Before the ETF era, large asset managers had limited options for gaining exposure to Bitcoin in a regulated portfolio structure. Hedge funds and specialist crypto firms could buy the asset directly, but pension funds and traditional wealth managers faced far more barriers. Spot ETFs effectively solve that problem by allowing investors to access Bitcoin through familiar financial infrastructure. That change opened the door to a new category of market participants who allocate capital according to long-term portfolio strategies rather than short-term speculation. The result is a market that now contains a much deeper and more stable base of demand. This institutional participation can help explain why Bitcoin has appeared more resilient during recent geopolitical turbulence. When the market was dominated primarily by retail traders, price movements were often driven by rapid emotional reactions. News headlines triggered cascades of buying or selling because a relatively small number of participants controlled most of the liquidity. Today, the market includes pension funds, asset managers, corporate treasuries, and sophisticated macro traders who approach the asset very differently. These participants often accumulate positions gradually rather than chasing short-term momentum. That behavior naturally dampens volatility during periods of uncertainty. Analysts such as Lyn Alden have long argued that Bitcoin should be viewed primarily through a macroeconomic lens, rather than purely as a technology investment. Alden has repeatedly described Bitcoin as a monetary asset that competes with traditional stores of value, particularly in environments where monetary policy and geopolitical risk influence capital flows. In her research, she has pointed out that Bitcoin behaves differently depending on liquidity conditions and macro narratives at any given time. During certain phases of the cycle, it trades like a high-growth technology asset, while in other phases it behaves more like a hedge against monetary instability. The key point is that Bitcoin's role is not fixed, because the market around it continues to evolve. Another well-known analyst, Willy Woo, has also highlighted the importance of market structure when analyzing Bitcoin's behavior. Woo frequently notes that the growth of institutional demand and on-chain accumulation trends can dramatically alter how the asset reacts to external shocks. According to his research, long-term holders now control a significant portion of the circulating supply, which reduces the amount of Bitcoin actively traded on exchanges. When fewer coins are available for immediate sale, price reactions to negative news can become less dramatic. This dynamic effectively creates a stronger foundation beneath the market. Fidelity Digital Assets has also published research suggesting that Bitcoin's evolving role in portfolios may gradually resemble that of a macro hedge. Their analysts have emphasized that Bitcoin's fixed supply and global accessibility make it unique among financial assets. Unlike equities or commodities, Bitcoin does not depend on corporate profits, supply chains, or physical production. Its value is derived from network security, scarcity, and global consensus rather than traditional economic output. These characteristics allow it to behave differently from assets tied directly to economic activity. However, it is important to balance that perspective with the views of analysts who remain skeptical about the digital gold narrative. Some researchers argue that Bitcoin still behaves primarily as a high beta risk asset linked to global liquidity conditions. When central banks expand liquidity and risk appetite rises, Bitcoin tends to perform strongly alongside technology stocks. When financial conditions tighten and investors become more cautious, crypto markets often struggle. From this perspective, Bitcoin's resilience during the current moment may simply reflect temporary positioning, rather than a permanent structural shift. Another factor worth considering is the difference in trading hours between crypto markets and traditional financial markets. Bitcoin trades 24 hours a day, 7 days a week, which means it processes global events immediately. Stock markets, on the other hand, operate on fixed schedules that close overnight and on weekends. When geopolitical news breaks outside those hours, equity markets cannot react until exchanges reopen. Crypto markets therefore absorb the initial shock, while traditional markets appear to react later and more dramatically. This timing difference can sometimes make Bitcoin look more resilient, even though the two markets are simply responding at different speeds. Large markets also behave differently from small markets, and Bitcoin has grown enormously over the last decade. Early in its history, the entire Bitcoin market was tiny compared with traditional financial assets. A relatively small amount of capital could move prices dramatically in either direction. Today, Bitcoin represents a multi-trillion-dollar ecosystem connected to global capital flows, derivatives markets, and institutional investment strategies. Assets of that scale tend to react more slowly and more strategically to major events. That evolution alone changes how the asset behaves during periods of stress. Moments of geopolitical tension therefore act as real-world experiments for the digital gold theory. Investors suddenly face uncertainty about energy markets, global trade routes, and political stability, and they must decide where to allocate capital in response. Historically, those flows moved primarily toward assets such as gold, government bonds, and reserve currencies. Bitcoin did not exist during most of those historical crises, which means its behavior during modern events provides valuable new data. Each crisis reveals a little more about how investors perceive the asset. Gold itself has been rising in recent months as investors look for traditional safe havens during geopolitical uncertainty. That pattern reinforces the long-standing perception of gold as a store of value during unstable periods. But Bitcoin's resilience alongside gold raises an interesting question about whether investor behavior may slowly be changing. Younger investors and technologically focused institutions may increasingly view Bitcoin as a complementary hedge rather than a speculative novelty. If that perception spreads gradually across global markets, it could reshape how portfolios are constructed in the future. Of course, it would be premature to declare that Bitcoin has fully achieved safe haven status. 1 week or one crisis is not enough evidence to redefine an asset that is still relatively young compared with centuries-old monetary instruments like gold. Financial markets evolve slowly, and narratives only become widely accepted after repeated confirmation over time. Bitcoin would need to demonstrate resilience across multiple geopolitical events before most institutional investors reconsider its classification. That process could take years, rather than months. What this moment does show, however, is that the structure of the crypto market has matured significantly. Institutional participation has deepened liquidity, long-term holders have reduced circulating supply, and global infrastructure around the asset has become far more sophisticated. These changes create a market environment that behaves differently from the speculative cycles of the past. Bitcoin today is no longer a small experimental asset traded primarily by enthusiasts on niche exchanges. It has become a global financial instrument that interacts directly with macroeconomic forces. The most interesting takeaway from the current situation may therefore be the gradual transformation of Bitcoin into a macro asset. Instead of fitting neatly into traditional categories like equities or commodities, Bitcoin appears to exist somewhere in between. At times, it trades like a technology investment driven by innovation narratives. At other times, it behaves like a monetary hedge during periods of uncertainty. That hybrid nature makes the asset difficult to classify, but also potentially powerful within diversified portfolios. If Bitcoin continues to demonstrate resilience during geopolitical shocks, investor perception will inevitably evolve. Markets redefine assets gradually through repeated experiences rather than sudden shifts in opinion. Each crisis becomes another data point that analysts and investors use to refine their understanding of how the asset behaves. Over time, those data points accumulate and shape the broader narrative surrounding the asset class. That narrative ultimately determines how institutions allocate capital. For now, the digital gold debate remains open. Bitcoin has not conclusively proven itself to be a safe haven, but it has also not behaved like a purely speculative asset during this recent period of uncertainty. The truth likely lies somewhere in between those two extremes. Bitcoin is gradually integrating into global financial markets, while maintaining characteristics that distinguish it from traditional assets. That unique position may ultimately define its long-term role in the global economy. And that is why moments like this matter so much. They provide real-world evidence rather than theoretical speculation about how the asset behaves under pressure. Whether Bitcoin eventually becomes digital gold or remains a high-growth macro asset is still uncertain. But what is clear is that the market surrounding Bitcoin has matured significantly, and that maturation is beginning to change how the asset reacts to global events. Investors are watching closely because the implications could be enormous for the future of finance. Drop your thoughts in the comments, smash like, follow the show, and as always, we will see you at the top.